Welcome to Expert Conversations Unpacked, where Chatham experts break down important trends and themes we're discussing with clients in the capital markets. I'm Casey Irwin, and I'm a managing director within Chatham's valuation and reporting platform.
And I'm Tom Miller, CIO of Union Square Capital Partners, a subsidiary of Chatham. And we're excited to welcome you to our second episode of Expert Conversations Unpacked. Today we'll be discussing top-of-mind themes as we enter the last 2 months of the year.
There's a wide range of questions we've been hearing from our clients, from questions around what to expect in the capital markets for the rest of 2024, to questions on which forces are the most important to track in the world's economies today, to questions on how to think about risk management within the context of an election year.
Our colleagues, Jackie Bowie and Amal Dargalkar, touched on several of these topics at a recent webinar, but we wanted to dive a bit deeper based on feedback we received from that webinar. And for those listeners who haven't had a chance to catch the webinar yet, you can find the replay link in the show notes. So Casey, are you ready?
I'm ready.
Great, let's get into it.
All right, Tom. So great catching up with you today. One of the interesting things I've noticed within 2024 is that roughly half the world's population is set to or has voted in this year. So it is a voting year. In just about every one of those elections, though, cost of living is a key topic in the minds of voters. So how is this playing out in the U.S. conversation, as well as in some of the other countries that we're seeing go to the polls?
Yeah, you're exactly right. Inflation and cost of living is the number one concern worldwide. That's no different in the U.S. Ironically, many of the politicians across the world are promising tax cuts and spending to help their constituents, but that's effectively got the possibility to keep inflation hotter than what many are expecting. So that may provide short-term relief, but will have horrible long-term consequences. I think most importantly, nobody cares that CPI was once 9% and now it's down to 3, right? What everybody cares about is the fact that when they go to the grocery store and they were spending $200 a week, now they're spending $300 a week. And so I think that's what makes this election a toss-up. People are going to vote on emotion, as they always do, and we are right in the midst of a strongly contested election and top of mind issues. So it really is going to come down to how people are feeling when they enter those polls.
So when we think about the Fed's mandate, both on stable pricing and maximum employment, can the Fed tackle both of those at the same time? Are there downstream impacts for investors when they try to do this?
Yeah, it's a hard job, let's be honest, right? And most of the time, the Fed just has to worry about employment. Inflation only pops up every now and again, at least in the US. And so now that they've shifted from tackling inflation with taking rates up an unprecedented 550 basis points and now, starting to ease, I think they have it right in the focus on employment at this point. If we lose employment, so if we lose full employment, we have a real problem on our hands as consumer sentiment will drop precipitously, and that will lead them to pull back. And the strong point of this economy to date has been the resilient consumer. And so we don't want to do anything that's going to jeopardize that. And I know, again, there's a big debate out there on whether inflation, dare I say the word transitory. I think you just have to elongate that word. Inflation certainly started as a supply shock issue, and the Fed reacted accordingly. But remember, the Fed only has tools for demand. And so now that the supply shock has worked its way through the economy, it looks like that's been a big component of bringing inflation down. So now it's up to the Fed to make sure that they don't unnecessarily constrain demand.
Hmm. One of the things we saw come out on October 4th was non-farm payroll data, which came in higher than expected. And we saw S&P reach record levels. Does this change any of the way that Fed is looking at future rate cuts?
From the commentary I've seen all the Fed governors make at this point, I don't think so. Of course, it'll give them pause. They don't want to be wrong. But let's not be too hyper-focused on one data point, right? It's funny to me how the market so overreacts to individual data points like the jobs number. And let's not forget, this was a number that was just revised over the last year by almost 1 million jobs. So we've seen revisions, although late they've been slightly positive revisions. There can also be large downside revisions. So I wouldn't be too focused on one number, but it's certainly something to watch. And in terms of do they change course, I don't think so at this point. I think we should probably take Powell at his word. His most recent commentary to the market, he believes there's 2 more rate cuts coming for the year. So I don't see any reason to veer off of that at this point. We'll have to watch CPI reads, PPI reads, and of course, employment. But at this point, there's consensus that they are in restrictive territory and they want to try to pull this soft landing off. So they're going to continue to bring rates down to do that.
When the Fed minutes were released recently, it was clear that there was some discussion amongst policymakers whether or not down 50 basis points or down 25 basis points was right for September. Obviously, they went with down 50. And it's just interesting to hear as more data comes out. CPI data recently came out. Also, kind of boosted the markets a bit. I think we heard folks like President Bostic say that they were open to potentially skipping a November cut. What other types of data do you think they're gonna be focused on as we get in advance of that November meeting?
Well, the Fed, I mean, they have smart economists, so I think they're going to be paying attention to all economic indicators, especially leading economic indicators. So they're going to be watching things like ISM new orders to make sure that they are on the right track. One thing I would note though is interest rates are typically what they call anticipatory economic indicators, and it takes about 24 months for interest rate moves to show up in GDP. So I'm kind of in the camp, maybe non-consensus view, that we have not seen the lags work through yet. And so you could see some real volatility moving forward as interest rates start to bite. And I know they haven't as of late, and that's mainly because many of your corporations termed out their debt. But higher interest rates will certainly start to play through the economy. And when that happens, I think you're definitely going to see a bigger slowdown than what many may be anticipating. So it's a time for volatility. Obviously, I'm hopeful that the Fed has this exactly right. We get through this, and what we've seen in history does not replay itself. But I'm still skeptical with interest rate moves that drastic in that short of a time frame. I'm a bit skeptical that they're not going to have lagged effects coming through in the next year or so.
So the Fed meeting is scheduled for November 6th and 7th. US will go to the polls on November 5th. That is gonna be an action-packed week for the markets. How are you recommending clients prepare?
Complacency doesn't work here. I think that is the general theme. You need to hedge risks where you can and be prepared for volatility. It will be an action packed week, but to some extent, you will get some clarity, obviously, on a presidential win. Now, I say that with a smile on my face because maybe we won't know that week. Maybe it takes a couple more weeks to really figure out who won the election. That said, I think you really have to be careful here and you really have to vote on policies. Unfortunately, neither candidate's policies are going to be all that great as it relates to fiscal spending. We have a real fiscal spending problem, and it's what's driven the economy so far and kept us somewhat resilient. But that game will end eventually, and we are already at record levels of debt. So you really have to be careful and pay attention to the policies that each candidate is bringing out. What's interesting is neither candidate is all that clear on their policy, so it's really hard to project this. But I do think that you have to take the entire picture. You have to look at the debt picture. You have to look at policies and vote accordingly. But no matter which way it goes here, we're definitely in for some pretty significant bouts of volatility.
So it's interesting you mentioned fiscal policy because we've talked a little bit about monetary policy. And when looking at Fed dot plot, target for normalized rates is in that 3% range, and the intent is to get there between 2026 and 2027. How could fiscal policy impact this path? And I guess what are some of the potential factors that are driven by election outcomes that can make this path more or less likely?
Yeah, so fiscal spending has won the day here in terms of keeping the economy afloat. What's interesting is the CBO estimates right now the deficits will average about 6% of GDP over the next decade, and we're going to climb to about 50 trillion or 122% of GDP by 2034. This path is just simply unsustainable. And oh, by the way, that CBO projection factors in a 10-year yield at an average of 3.9%. And what you really want to watch for here, we haven't seen this since the 70s, but you have to be careful because the market is the mechanism to rein in fiscal spending, right? And so, what would happen there if the market says, all right, we've had enough? We want higher interest rates. We want to be rewarded for the risk we're taking because the United States is so irresponsible at this point, and you see your longer term rates start to shoot up. That would be problematic for all risk assets. And obviously we're hopeful that doesn't happen, but that's why this election matters so much. We've got to rein in fiscal spending. Neither, I think, are prepared to do that. But it's got to be the lesser of the bad scenarios, right? I think it has tremendous implications on monetary policy moving forward. There's only a few ways to get out of this problem, this fiscal problem that we're in. There's really 5 ways to do it. You can grow your way out of it, being fiscally responsible. The growth rates you need to hit there, though, I just don't think the US is capable of hitting. Austerity measures, that doesn't get anybody elected. That's going to be a non starter if you go to the retirement population. Say, oh, by the way, we're going to wind back Social Security benefits. You're never going to get elected. You can inflate your way out of it, but we've learned everybody hates inflation, right? And that has to be more of an inflation surprise. You can default. The United States government is not going to default. That would wreak havoc on the world. And there's some level of financial repression that could come in, and that's just laws, policies, regulations, resulting ultimately at the end of the day, keeping interest rates artificially low so you can work your way out of the debt problem. Obviously, we don't have a country where monetary and fiscal policy works together. That's abundantly clear over the last few years. And so it will be an interesting dynamic here on moving forward how these two sets of policies work in tandem.
Yeah, you mentioned growth rates. When I was looking at some of the debt to GDP ratios, I think the last time we saw the ratio, I think we're at 106% of GDP today. The last time we were at this level was roughly around the end of World War II. Interestingly, the growth rate was about 3.6%. We're at about 1.4. So to your point around what's feasible in the short term to be able to address this, we may not have the same levers. Is this a long-term issue? Is this a slow burn issue? And how should clients be thinking about the impacts of this as it relates to risk management?
I think it's a little bit of both. It's certainly a long term issue, and it will come through in longer term rates and over years that play out. That said, if fiscal spending doesn't stop and keeps inflation hot, the Fed's going to react. We've already seen them do it. So they're going to react, even though it may not seem as though it works. It's what they know. Right. So if inflation's hot, they're going to take interest rates up to try to cool the demand side. So you do have short and long term risks. So you really have to be careful here, like I said, on fiscal spending. Now, we do have things coming up that potentially could help. You have parts of legislation that are set to expire on taxes. But again, you have a problem where both candidates are saying they're going to have tax cuts, and that could be problematic. At the end of the day, it's really a simple balance. It's kind of how you would run your budget at home. You have to bring in enough revenue to pay for the things you want to pay for. So, I find it hard to believe that we can keep on this path. And like I said, the CBO is already projecting that we are going to be 123% debt to GDP by 2034. If you look at what we know of the candidates' policies today, you're looking at a Harris administration adding about 3.5 trillion to that number over the next 10 years. Ironically, a Trump administration is going to be more than double that. So current projections look to be about 7.5 trillion. The problem is both of the candidates tend to say things when they're on an open mic and make promises, buy their votes, if you will. So they continue to roll out their policies almost by happenstance on the crowd that they're addressing at the time. So really need to pay attention, but I think you have both short and long term risks depending upon the candidate that is selected here.
What do you think about the energy sector? So we've been watching oil specifically go down in price. I think when I looked at US crude, it's been dropping at a decent clip, and especially with some recent economic news coming out from China and stimulus expected there. How do you think energy impacts spending?
Well, so if you look back, there's a high degree of correlation between headline CPI and oil prices. Not that the Fed will overreact to headline CPI, they focus on core. It still will make the Fed uncomfortable if the headline CPI number is up. And of course, it'll hurt consumers, right? We pay more for gas, et cetera. This is something we really need to watch. We have a lot of geopolitical instability that's driving this. But more importantly, China, again, is coming out with fiscal stimulus really all over the place to try to get their economy going. And what you really need to pay attention there is as demand picks up there, they're going to import more crude, and therefore it will drive the price higher. So you really have to keep things in balance here. The good news for the US is we are now an exporter of oil, but I don't know that that's enough today to sustain the global demand for oil, especially if China really gets going here. So it's something else, just another worry in the wall of worry, if you will, but it's something we really need to pay attention to.
Yeah, it's very interesting during these periods where there's a lot of activity both happening, to your point, on the geopolitical front, on the macroeconomic front. Clearly, when it's an election year, you add an entirely new layer of complexity, and clients want to understand how to prepare, especially when we saw rates drop or yields and treasuries drop over the course of August. You could see some of the clients who had prepared for opportunistic moves. They had looked at their portfolios, understand what legwork needed to be done, and were able to transact. As we head into the last couple of months this year, what kinds of preparations should our clients be thinking about so they can be similarly agile?
It's easy for me to say, oh, they should just hedge their risks. So, in a way, I will put this back on you. What are some of the specifics you've seen some of the capital markets teams for some of the clients that you work with? What are they doing specifically? And is there any read on what they think is coming up in the presidential elections?
Sure. So I think there's a lot of proactive planning that's happening. What clients are doing is making sure that they have contingency plans for any outcome. And those plans are fairly detailed and thought through, mostly because you don't know when the volatility will arise. So we saw clients who were closely evaluating their portfolios to understand where did they have near-term risk from an interest rate perspective? Are there hedges that they needed to re-up or to put in place opportunistically? What does their maturity ladder look like? How do they create flexibility so that if rates do drop faster than expected, there are mechanisms to take advantage of that? Albeit that's a little bit asymmetrical because I think they're very concerned that rates stay higher. And so they want to make sure they're mitigating that type of risk. So clients were spending a lot of time planning. They were going through some of the steps that needed to take place to make sure they were prepared. Some of these are decisions that you may make, but then need a variety of tactical exercises to actually execute upon. So you have to have the pieces lined up and organized. Otherwise, the moment can pass. We saw some dip in August in treasury yields, and the clients we worked with who had been thinking about and preparing for this very quickly took advantage of that. I think other clients who were not as prepared maybe didn't get a chance to take that opportunity. And so I think many of our clients right now are evaluating how can we be prepared for the variety of situations we may find ourselves in, help us understand where in our portfolios we should be focused on for these types of risks, and what are the actual steps we need to do so that when the time is right, we can move.
And so let me ask you to that effect. Are the Fed cuts of 25 or 50 at this point really all that meaningful? Do you see any clients actually positioning and saying, well, if the Fed cuts 25, then this, or if they cut 50, then that?
I think so much is baked in at this stage, and I think there's certainly a opportunity for surprises. I think again to the point of we saw a 50 basis point cut in September, and I think a good contingency folks were thinking it might actually only be 25. So there could be marginal changes, but I don't think we're expecting a Fed increase, for example. And I don't think our clients are either. So most of the planning is based on what seems to be highly probable scenarios. And they're continually watching the market to understand how this evolves. So, to our point earlier around the fact that new data continually comes out, there are clearly events on the global platform that can influence this picture. There's a lot of time being spent to make sure people have the latest and greatest information and data to be making decisions. So, again, whether it ends up being a 25 basis point cut at the subsequent two meetings for the rest of 2024, or if for some reason it ended up being only 25 basis point, I don't think that would end up creating a big change in behavior.
What are you hearing from clients about the impacts or their concerns regarding the election specifically? Do you hear anyone talking about it?
I don't think that we have heard any particular political views from our clients. What I do think they're thinking about, and I think you mentioned this earlier on, was how will this change policy? So, where will we see changes to taxes? Where will we see changes to spending? How does that influence our asset allocation when we look at the places we're investing, especially if you're a fairly complex investment manager? You're going to be spending some time trying to understand how these views of either candidate could change the landscape for the next 4 years, not necessarily the next 12 months alone. And so much of that presidential candidate and the outcome of that election is really driving the direction action on a longer term horizon that I think influences some of the decisions our clients make. So while I don't expect there to be significant changes from an investment perspective based on which candidate wins, I could see there being decisions that play out over the next several years that are a result of some of the policy implications of either candidate.
And are you starting to see, by and large, everyone is thinking that rates are coming down moving forward, has been forecasted by the Fed? Are you seeing activity really start to pick up, or do you see some clients are waiting before they start to transact to say, okay, we know rates are coming down even further, so we will just wait? Have you seen that lift already in saying, nope, now is the time to get into the market?
Interestingly, I think we're seeing a couple different behaviors. So, one, I think there are questions around we have some expectations around maturities in our debt portfolios. When do we want to begin going back out into the market to refinance those positions? And again, obviously, they'd prefer to do that in a lower rate market than a higher rate market. At the same time, we have clients asking, we understand rates are expected to fall, but how quickly is that going to take place? Powell was using the term gradual, and I think there's a lot of ways to interpret that. I think they've been pretty specific in their guidance through the end of this year, but to get to that target rate environment of around 3%, there needs to be continued activity as we move into 2025 and 2026. So, when we're talking about gradual rate cuts, over how long of a protracted period will that be? Depending on how quickly that happens, there are some clients who are focused on whether or not they should be entering into hedges and saying, hey, if rates fall slower than what we expected it to be, do we want to lock in some of that downward sloping forward curve? That inverted forward curve is attractive because that's where you've seen more of those rate cuts baked in. So I think those are the types of questions our clients are asking and trying to decipher as they think about not only the construct of their portfolios, but also how to manage that risk when clearly there are a lot of pieces still moving in the market.
Yeah, it'll be interesting to see how it plays out because the Fed, I think, obviously wants that gradual path. But if you look at history, of course, they want the gradual path until something breaks and then it happens all of a sudden. So I guess only time will tell where things go with interest rates. But not that we want to be alarmist, but there's certainly a lot to worry about in the markets today. And the next 30 or 40 days will be telling and hopefully provide a little bit of clarity, at least on who will take the presidency and what the makeup of Congress looks like.
Absolutely. All right, so this wraps up our episode of Expert Conversations Unpacked. We appreciate you taking the time to listen, and we'd love it if you would subscribe on Apple, Spotify, or YouTube to catch up on past expert conversations and stay up to date on future episodes.
We are also hosting an hour-long webinar on November 14th called Navigating 2025: Key Trends and Strategies in Capital Markets. You can register in the link in the show notes, and we hope to see you there.
And we'd love to hear your feedback on topics we've covered, other people and perspectives you'd like us to include, or anything else that we can do to make your listening experience more enjoyable. Use the link in the show notes to send us a message.
Thanks again for tuning in.
Until next time.